Question 1. In Texas, what is the minimum free look period that must be provided for a new life insurance policy? A. 5 days. B. 10 days. C. 15 days. D. 20 days. Answer: B. 10 days. The free look period, also known as the right to examine period, allows a policyholder to return a new life insurance policy for a full refund of premiums paid if they decide they don't want it, without incurring surrender charges. In Texas, state law mandates a minimum 10-day free look period for life insurance policies, starting from the date the policy is delivered to the insured. This provision ensures consumers have adequate time to review their policy and make an informed decision, protecting them from impulse purchases. Remember, this period begins upon policy delivery, not when the application is signed. Question 2. The Texas Department of Insurance, TDI, is responsible for all of the following except: A. Enforcing insurance laws. B. Issuing licenses to agents and adjusters. C. Setting insurance premium rates for all lines of insurance. D. Approving insurance policy forms. Answer: C. Setting insurance premium rates for all lines of insurance. The Texas Department of Insurance, TDI, is the primary regulatory body for the insurance industry in Texas, tasked with protecting consumers and ensuring a stable and competitive market. While TDI is responsible for enforcing insurance laws, licensing agents, and approving policy forms to ensure they comply with state regulations, it generally does not set specific premium rates for all lines of insurance. Insurers typically propose rates based on their own actuarial data, which TDI then reviews for fairness and solvency, but TDI does not dictate the rates themselves. Think of TDI as the referee, not the coach, in the insurance market. Question 3. An incontestability clause in a Texas life insurance policy prevents the insurer from denying a claim based on misrepresentations in the application after the policy has been in force for a specific period, typically A. 6 months. B. 1 year. C. 2 years. D. 3 years. Answer: C. 2 years. The incontestability clause is a crucial provision in life insurance policies designed to protect the beneficiary from having a claim denied years after the insured's death due to innocent or unintentional misstatements on the original application. In Texas, this clause typically states that after a policy has been in force for 2 years from its issue date, the insurer cannot void the policy or deny a claim based on material misrepresentations made in the application, unless the misrepresentation was fraudulent. This means if a policyholder unknowingly misstated their age, for example, the insurer generally cannot contest the claim after 2 years, providing certainty to the policy's beneficiaries. Question 4. Which of the following statements about term life insurance is false? A. It provides coverage for a specific period of time. B. It builds cash value over time. C. It is generally less expensive than whole life insurance in the initial years. D. It pays a death benefit if the insured dies during the policy term. Answer: B. It builds cash value over time. Term life insurance is designed to provide coverage for a defined period, or term, such as 10, 20, or 30 years. It pays a death benefit only if the insured dies within that specific term. Unlike permanent insurance types like whole life, term life insurance does not accumulate cash value, which means it cannot be borrowed against or surrendered for cash. Its primary advantage is its affordability, offering maximum coverage for the lowest initial premium, making it ideal for covering temporary needs like a mortgage or children's education. Question 5. In Texas, an annuity is a contract that provides A. A lump sum payment upon the death of the annuitant. B. A guaranteed period of income payments that begin immediately. C. A systematic liquidation of a sum of money, either principal or principal plus interest, over a specified period or for life. D. A tax-deductible contribution to a retirement account, regardless of income. Answer, C. A systematic liquidation of a sum of money, either principal or principal plus interest, over a specified period or for life. An annuity is fundamentally a financial product designed to provide a steady stream of income, often for retirement. It functions as a systematic payout of a lump sum of money or accumulated contributions, returning either the principal amount, or principal plus any accumulated interest or gains, over a set period or for the lifetime of one or more individuals. While some annuities can have a death benefit, their core purpose is income distribution, making them distinct from life insurance, which primarily offers a death benefit. Think of an annuity as reverse life insurance, because it protects against living too long and running out of money, whereas life insurance protects against dying too soon. Question 6. If a primary beneficiary predeceases the insured, and no contingent beneficiary is named, the death benefit of a life insurance policy will typically be paid to A. The insured's estate. B. The insurer. C. The state's general fund. D. The Texas Department of Insurance. Answer, A. The insured's estate. When a primary beneficiary dies before the insured, and no contingent, secondary, beneficiary has been designated by the policyholder, the death benefit proceeds of a life insurance policy are typically paid to the insured's estate. This means the funds would then be subject to probate, and distributed according to the deceased's will or the laws of intestacy if there is no will, which can delay the distribution of funds. It's crucial for policyholders to regularly review and update their beneficiary designations to ensure their wishes are honored and to avoid the complexities of probate. Question 7. An insurance agent who convinces a policyholder to lapse an existing policy and purchase a new one with a different insurer, to the detriment of the policyholder, has engaged in the unfair trade practice known as A. Rebating. B. Twisting. C. Defamation. D. Churning. Answer, B. Twisting. Twisting is an illegal and unethical practice where an insurance agent persuades a policyholder to surrender, lapse, or forfeit an existing life insurance policy or annuity in order to purchase a new one, when the new policy does not genuinely benefit the policyholder. This often involves misrepresenting policy terms, and the new policy might have higher premiums, new waiting periods, or reduced benefits. The key detriment is that the policyholder loses accumulated value or favorable terms from their old policy. Always remember that replacing an existing policy should only occur if it is clearly in the best interest of the client, not the agent's commission. Question 8. In Texas, an individual must be licensed as a life and health agent to sell which of the following products? A. Only traditional whole life policies. B. Only group health policies. C. All types of life insurance and annuities. D. Property and casualty insurance. Answer, C. All types of life insurance and annuities. To sell any form of life insurance or annuity product in Texas, an individual must hold a valid life and health insurance agent license issued by the Texas Department of Insurance, TDI. This license covers a broad range of products, including term life, whole life, universal life, variable life, though variable life requires an additional securities license, and all types of annuities, ensuring that agents are knowledgeable about these complex financial instruments. This licensing requirement protects consumers by ensuring that only qualified individuals advise on and sell these products. Question 9. Which characteristic is typically associated with group life insurance? A. Individual underwriting is required for each member. B. Evidence of insurability is generally not required for most members. C. It builds significant cash value for each individual participant. D. Premiums are always paid entirely by the individual employees. Answer, B. Evidence of insurability is generally not required for most members. Group life insurance is often provided by employers or other organizations to a group of people, offering coverage with a major benefit being simplified underwriting. For most members, especially if they enroll during the initial eligibility period, evidence of insurability, like a medical exam, is generally not required, which makes it easier for individuals who might not qualify for individual policies. Premiums are typically lower per person compared to individual policies, and the policy often does not build cash value. This setup helps employers offer a valuable benefit to their workforce efficiently. Question 10. A policy loan in a whole life insurance policy. A. Must be repaid by the insured before the policy can lapse. B. Reduces the policy's cash value but does not affect the death benefit until repayment. C. Can be taken only if the policy has been in force for at least 10 years. D. Reduces the death benefit if not repaid by the time of the insured's death. Answer: D. Reduces the death benefit if not repaid by the time of the insured's death. Whole life insurance policies accumulate cash value over time, which policyholders can borrow against in the form of a policy loan. While policy loans do not have to be repaid, any outstanding loan balance, including accrued interest, will be deducted from the death benefit paid to the beneficiaries when the insured dies. This means the beneficiaries will receive a reduced amount. It's important to remember that the cash value itself acts as collateral for the loan, and interest continues to accrue on the outstanding balance until repayment or death. Question 11. The Texas Life and Health Insurance Guaranty Association provides protection to policyholders in the event that a member insurer becomes A. Financially insolvent. B. Subject to a class action lawsuit. C. Involved in an unfair trade practice. D. Acquired by another company. Answer: A. Financially insolvent. The Texas Life and Health Insurance Guaranty Association, TLIGA, is a nonprofit legal entity created by state law to protect policyholders and beneficiaries of life and health insurance policies and annuities. If a member insurance company becomes financially insolvent and cannot meet its obligations, the Guaranty Association steps in to pay covered claims up to certain statutory limits. This provides a crucial safety net, ensuring that policyholders do not lose their coverage or accumulated values solely due to the failure of their insurance carrier. It's similar to how the FDIC protects bank deposits, providing peace of mind to consumers. Question 12. When replacing an existing life insurance policy with a new one in Texas, the agent must ensure that the applicant receives a notice regarding replacement. The purpose of this notice is to A. Inform the new insurer of the existing policy. B. Ensure the agent earns a higher commission. C. Advise the applicant to compare the existing and proposed policies carefully. D. Automatically waive the free look period for the new policy. Answer: C. Advise the applicant to compare the existing and proposed policies carefully. The primary purpose of the notice regarding replacement of life insurance or annuity is to protect consumers by ensuring they are fully aware of the potential disadvantages and consequences of replacing an existing policy with a new one. This notice mandates that the agent clearly advises the applicant to compare the benefits, limitations, and costs of the existing policy with the proposed new policy before making a decision. It highlights potential issues like new incontestability periods, surrender charges, and loss of valuable policy features, prompting the policyholder to make an informed choice. Question 13. Which of the following is a characteristic of variable life insurance? A. It has a guaranteed minimum death benefit. B. Its cash value is invested in a separate account and is not guaranteed. C. It offers flexible premiums and adjustable death benefits. D. It primarily focuses on providing a guaranteed income stream during retirement. Answer: B. Its cash value is invested in a separate account and is not guaranteed. Variable life insurance is a type of permanent life insurance where the cash value is invested in a separate account, typically comprised of various investment subaccounts chosen by the policyholder, similar to mutual funds. Because the cash value fluctuates based on the performance of these underlying investments, it is not guaranteed and can increase or decrease, impacting the policy's overall value. Agents selling variable life must hold both a state life insurance license and a FINRA securities license due to the investment component. This makes it distinct from traditional whole life policies where the cash value grows on a guaranteed basis. Question 14. A waiver of premium rider attached to a life insurance policy means that if the insured becomes totally and permanently disabled, A. The policy will pay a disability income benefit. B. The insurer will pay the policy premiums on behalf of the insured. C. The policy's cash value will be frozen. D. The policy's death benefit will increase. Answer: B. The insurer will pay the policy premiums on behalf of the insured. The waiver of premium rider is a valuable benefit that can be added to a life insurance policy, typically for an additional cost. If the insured becomes totally and permanently disabled before a certain age, as defined in the policy, this rider ensures that the insurer will pay all future premiums for the duration of the disability. This prevents the policy from lapsing due to the insured's inability to pay premiums during a time of financial hardship, thereby keeping the death benefit and any accumulated cash value intact. It's a key protective feature for the policyholder. Question 15. If an insured misstates their age on a life insurance application, the Texas Insurance Code provides that the insurer will typically A. Void the policy and refund all premiums paid. B. Deny the claim entirely. C. Adjust the death benefit to what the premium would have purchased at the correct age. D. Charge the beneficiary the difference in premiums. Answer: C. Adjust the death benefit to what the premium would have purchased at the correct age. The misstatement of age clause is a standard provision in life insurance policies that addresses situations where the insured's age was incorrectly stated on the application. Rather than voiding the policy, which would be unfair to the beneficiary, the insurer will adjust the death benefit. If the insured was older than stated, the death benefit will be reduced to the amount the premiums paid would have purchased at the correct, older age. Conversely, if the insured was younger than stated, the death benefit would be increased. This provision ensures the policy remains in force and that the premium paid matches the true risk undertaken by the insurer. Question 16. In Texas, the minimum grace period for a life insurance policy premium payment is A. 7 days. B. 15 days. C. 30 days. D. 60 days. Answer: C. 30 days. The grace period is a specified length of time following the premium due date during which a policy owner can still pay the premium without the policy lapsing. In Texas, state law mandates a minimum 30-day grace period for life insurance policies, or 1 month, whichever is longer. This provides policyholders with a safety net, ensuring that their coverage remains in force even if they are a few days late with a premium payment, and that the death benefit would still be paid if the insured dies during this period. Question 17. Which statement accurately describes the characteristics of a universal life insurance policy? A. It has fixed premiums and a guaranteed death benefit. B. Its cash value grows based on the performance of a separate account, with no guarantees. C. It offers flexible premiums and an adjustable death benefit. D. It provides coverage for a specified term, with no cash value accumulation. Answer: C. It offers flexible premiums and an adjustable death benefit. Universal life (UL) insurance is a type of flexible permanent life insurance. Key features of UL policies include adjustable premiums, meaning the policyholder can vary the amount and timing of premium payments, within certain limits, and an adjustable death benefit, allowing the policyholder to increase or decrease the coverage amount as their needs change. The policy's cash value grows based on interest earned, typically at a declared rate, and it offers transparency by showing the mortality, expense, and interest components separately. This flexibility makes UL appealing for those whose financial needs might change over time. Question 18. The Commissioner of Insurance in Texas has the authority to do all of the following except A. Conduct examinations of insurance companies. B. Enact new insurance laws. C. Issue cease and desist orders. D. Adopt rules to enforce insurance laws. Answer: B. Enact new insurance laws. The Commissioner of Insurance, as the Chief Executive of the Texas Department of Insurance, TDI, has significant power to regulate the insurance industry. This includes the authority to examine insurers, issue cease and desist orders to stop illegal practices, and adopt rules and regulations to implement and enforce the insurance laws passed by the state legislature. However, the Commissioner does not have the power to enact, create or pass new insurance laws. That authority rests solely with the Texas state legislature. The Commissioner's role is to administer and enforce, not to legislate. Question 19. An agent must disclose the fact that they are acting as an insurance agent and provide their full name and the name of the insurer they represent during which stage of the sales process in Texas. A. Only upon delivery of the policy. B. Only if specifically asked by the applicant. C. At the time of initial solicitation or application. D. After the policy has been approved by underwriting. Answer: C. At the time of initial solicitation or application. In Texas, agents are required to make full and clear disclosures to potential clients from the outset of the sales process. This means that at the very first point of contact, or at the time of the initial solicitation or application, the agent must clearly identify themselves as an insurance agent and state the name of the insurer they represent. This ensures transparency and helps prevent any misunderstanding about the agent's role and the company they are working for, protecting consumers from deceptive practices. Question 20. Which principle states that the insurer is entitled to the truth from the applicant, and the applicant is entitled to the truth from the insurer, in a Texas insurance contract? A. Adhesion. B. Indemnity. C. Utmost good faith. D. Aleatory. Answer: C. Utmost good faith. The principle of utmost good faith, uberrimi fidei, is fundamental to all insurance contracts, including life insurance in Texas. It means that both parties to the contract, the insurer and the applicant/insured, must deal with each other honestly and fully disclose all material facts relevant to the contract. The applicant must accurately represent their health and other risk factors, and the insurer must accurately represent the policy's terms and conditions. This principle is crucial because insurance contracts are based on information asymmetry, where one party often has more information than the other. Question 21. If a whole life policy owner in Texas surrenders their policy for its cash value, which non-forfeiture option are they utilizing? A. Extended term. B. Reduced paid up. C. Cash surrender value. D. Automatic premium loan. Answer: C. Cash surrender value. Non-forfeiture options are provisions in permanent life insurance policies that allow the policyholder to retain some value from the policy if they stop paying premiums. When a policyholder surrenders their policy and chooses to receive the accumulated cash value in a lump sum, they are utilizing the cash surrender value option. The other common non-forfeiture options are extended term, using the cash value to purchase a new term policy for the same death benefit amount for a limited term, and reduced paid up, using the cash value to purchase a new, fully paid up policy with a smaller death benefit. Question 22. Which of the following is not a feature of an adjustable life policy? A. The policyholder can change the policy's death benefit. B. The policyholder can change the policy's premium payments. C. The policy automatically adjusts to inflation. D. It combines features of both term and whole life insurance. Answer: C. The policy automatically adjusts to inflation. An adjustable life policy is a type of permanent life insurance that offers significant flexibility, allowing the policyholder to adjust various aspects of their coverage. This includes the ability to change the death benefit amount, increase or decrease premium payments, and even shift between term and whole life coverage characteristics, all within the same policy. However, adjustable life policies do not automatically adjust for inflation. While some policies might offer riders that provide inflation protection, it's not an inherent feature of the base adjustable life policy itself. Question 23. A reinstatement provision in a Texas life insurance policy allows the policy owner to a. Change beneficiaries without consent. b. Reactivate a lapsed policy within a certain timeframe, usually by paying back premiums and proving insurability. c. Convert a term policy to a whole life policy. d. Receive a refund of all premiums paid if they cancel the policy. Answer: B. Reactivate a lapsed policy within a certain timeframe, usually by paying back premiums and proving insurability. The reinstatement provision offers a valuable opportunity for policy owners to restore a lapsed life insurance policy, rather than having to purchase an entirely new one. To reinstate a policy, typically within a specific time frame, example 3 to 5 years, after it has lapsed, the policy owner usually must pay all overdue premiums plus interest, repay any outstanding policy loans, and often provide evidence of insurability, example a medical exam, to prove they are still a standard risk. This allows the policyholder to regain their original policy with its original issue age and cash value. Question 24. What is the primary purpose of the Medical Information Bureau, MIB? A. To provide medical treatment for insureds. B. To conduct medical exams for insurance applicants. C. To collect and share medical information among insurers to detect fraud and misrepresentation. D. To set guidelines for insurance company underwriting. Answer: C. To collect and share medical information among insurers to detect fraud and misrepresentation. The Medical Information Bureau, MIB, is a non-profit association that collects and stores medical and other health-related information on applicants for life and health insurance. Its primary purpose is to serve as an information exchange between member insurance companies, helping to prevent fraud and misrepresentation on insurance applications. When an individual applies for insurance, the insurer can check the MIB database to see if the applicant has previously disclosed any significant medical conditions to other MIB members, ensuring consistency and preventing applicants from concealing vital health information. Question 25. An applicant for a life insurance policy in Texas is required to sign a consent form before an HIV test can be administered. This consent form must include all of the following except A. A description of the confidential nature of the test. B. The identity of the proposed insured. C. An agreement that the insurer will provide free counseling services if the test is positive. D. Information about who will receive the test results. Answer: C. An agreement that the insurer will provide free counseling services if the test is positive. In Texas, strict regulations govern the collection and use of HIV test results in insurance underwriting. When an HIV test is required, the applicant must provide written consent, and this consent form must inform them about the confidential nature of the test, who will receive the results, example the insurer, MIB, and that the results will not be used for any purpose other than evaluating insurability. While ethical insurers may recommend or provide resources for counseling, there is no state requirement for the insurer to agree to provide free counseling services if the test is positive.